Welcome to this video. Today guys, I will present to you 4 essential concepts for mastering algorithmic trading. First of all, join the YouTube channel and subscribe to the Telegram in the description. Let's start the video now. Here we go. So in this video, we will look at 4 essential concepts for mastering algorithmic trading. And you might ask me, what is algorithmic trading? Well, it's very simple. It's about mechanically understanding how the price moves from point A to point B. I made it very simple for you. If you don't understand why the price dropped from here to here, well, you will understand by the end of this video. So stay tuned to grasp everything. Alright guys, let's be clear. In algorithmic trading, you shouldn't overthink it, okay? It shouldn't be difficult, it should be mechanical, it should be applicable, and it should be automatable. That is the goal of algorithmic trading. So we only need 4 concepts. And if these 4 concepts are mastered, then that is sufficient. We don't need to get lost in a mass of information to have 10,000 concepts and a strategy that ultimately leads to nothing because we have 50 ways to enter, 10 ways to exit, and in the end it drives us crazy. So the 4 things we need are to understand transactional flows through market structure, efficiency principles, liquidity, and timing. Once we have grasped these 4 things, we will be able to trade. We will start with the first thing, and that is the beginning of this video. So let's get started with understanding transactional flows. But transactional flows will be utilized through market structure. I assure you, in this video, for each concept we will cover theoretically, I will provide a practical example and give you a correction so that you can apply it from home. And by the end of this video, you will be fully capable of trading. So the first thing we will have is the market structure, as I just mentioned, and we have 2 tasks to perform. The 2 tasks are simple. First, we need to look for opposing candles. When do we look for opposing candles? From the moment we break a high or break a low, okay? So if I break a lower low, it means that I have had bearish candles since we broke a lower low. At the first bullish candle, I will be able to draw a structure point. That is our first task to do. I'll give you the opposite example. We are bullish, right? We break a higher high, so we break a higher high with bullish candles. So far, I think it makes sense to everyone. The first task to perform is simply to find the first bearish candle. There you go. That's our task number 1. And every time we create a new high, we just need to find the last low. Because if I create a low, it means there is a high that is responsible for it. So this is really a task that is even simpler. That is to say, from the moment I broke my structure here and I had my opposite candle, I will just look for the lowest point that was responsible for the break. We don't need to overthink it. I'll give you the example just to the right. For instance, here we were bearish and we made a liquidity grab, so we came to recover the highs. We'll see this in the liquidity part, which is part 3 of the video, so stay tuned until the end of this video. Once we had our opposite candle again, we will just look for the lowest point that was responsible for the break, and we found our new low. If you have any questions, don't worry. We will directly do a practical example to apply the theory we just covered. So we find ourselves directly on the first graphical part where we will apply our first theory. I remind you of the 2 things you need to do. Every time we break a high, as you can see here, we are definitely bullish. If we break highs, we are bullish. If we break lows, we are bearish. We will discuss the principles of efficiency right after to confirm this theory. As soon as we have a contrary candle, that becomes our first task. Then once we have found our contrary candle, we will be able to define as a second point what the lowest point responsible for our breakout was. So you see that we have a breakout right here, and the lowest point that was responsible for the breakout is this point. Now, what we do is that now that we've broken the highest point, we can perform our first task, which is to analyze our opposing candle. So we wait. For now, we don't have a contrary candle. So I have an algorithm that allows me to trace them automatically, but you will see how it's algorithmic and that you can do it from home in the same way. Okay, great. So here you can see that the bearish candle has indeed been drawn. So we have a high that has been detected. It is clear that from the bearish candle, the highest detected is indeed this one, and the lowest is simply this one that has always been marked. So we can restart our little diagram. I have a high point and a low point. Here. We will wait to see which of the 2 gets broken first, and then based on that, we will be able to define a new low. Okay? This will help us determine what the lowest point is from this location after our high that breaks our previous high. So, right here we can see that we have our lowest point marked, simply because the highest point was broken. Again by bullish candles, and the lowest point responsible for this break is located right here. So now our new job is to wait for the first opposing candle. We will be patient to find this first opposing candle. We still don't have a contrary candle. We still don't have a contrary candle. We have a contrary candle, so our new high is established right here. So, the lowest point remains this one, and we will be able to move our line once again, and the algorithm will repeat this work over and over. I think we don't necessarily need to do 50,000 examples. I'll give you one more. So, what does it do for us? Well, it has found the highest and the lowest points, right? Since we broke the highest point that was initially defined right here, the lowest point has indeed been found because the lowest point that breaks the highest is this one. Our new job, as you understood, is to wait for our first bearish candle. We are waiting for our first bearish candle. Here we have our first bearish candle. The line has been drawn directly. I think you understand the rubber traders. I'm giving you a little bearish case so you can understand, and we'll meet for the next part right after. Great, so we're just going to do a little KBC together with a liquidity grab so that you can understand everything, and I think we'll cover it all thoroughly. Next, I will give you a practice timeline with the results and the reveal so you can train. Similarly, I want to clarify here that we enter those lower and those higher. We will wait to see what is preferred, what decides to break first. So, patience. Patience, patience, patience. Okay, so here you see that the price first decides to break our low. Okay, so we continue to be bearish. We will first look for what the highest point is, alright? Our goal is first to look for the highs that will be responsible for the breakouts and then to find opposing candles. The high that is responsible for our breakout is simply this one. So it will give us our new high point that can continue the alternation. Okay, because this high is not the one responsible for the breakout. It is indeed this one. After this breakout, we can see that we have a bullish candle, so we have a contrary candle after the bearish candles that came to break, since we are in a bearish trend. Therefore, when we are bearish, we break lower lows with bearish candles, which seems logical to me. We have a candle that is at the deer, and we have a new lower low that is drawn. From that moment on, we simply know that our entire structure is well defined. We can move our analysis zones. We look again at our highest and again at our lowest, and we will see the case of a liquidity grab. I believe we have a liquidity grab, so there you go, perfect. You see that it's the same principle. We don't change anything here. We can see that we've broken upwards. Okay, very well. We will wait for the first bearish candle to be able to draw our high. Our first bearish candle is therefore established right here. Our low does not change because it is simply this low that was responsible for the break of the high. And we will be able to look once again between these two levels to see which one gets broken first. You understood it? It's always the same thing. Here we have broken downwards. You can see that we are bearish. Bearish candle, the point has been established. You have understood exactly how to trace the market structure. Now, I'm just going to hop that you have this indicator, and I'm going to give you a little exercise to do between here and here. I'll give you the reveal in a few seconds. You just need to pause the video. So I'll let you pause the video right now. And I'll give you the reveal now for the correction. Here we go. Let's move on to the video. Part 2 of the video discusses the principles of efficiency, and we start with the upward EPA principles. So to have an upward EPA principle, it's really not complicated, guys. What you need to do is first accurately draw your market structure. So thanks to the previous part, you now know how to draw your market structure well. You need a breakout, a second breakout, all right? Remember this well. The price must return to your buy zone. The price breaks out, it returns to your buy zone, and it gives you a second breakout. From the moment you have that, you are in an upward EPA. You can have a second case where you come from a structure that is bearish. So you see that there are downward breaks and you experience a first break. You draw your sell to buy, you make sure that the price returns inside the sell to buy, it gives you a second breakout, you are efficient to the upside. I will give you graphical examples right after. We will just do the downward P and the IPA principles, and then you will have fully understood the principles of efficiency. For the downward efficiency, it's exactly the same thing. We will first wait for a breakout and we will note this breakout. We are going to draw the buy to sell this time. We will wait to see if the price returns to this buy to sell. If the price returns to this buy to sell and gives us a second break, then we are entering a short position. Similarly, you can come from a bullish structure, create upward breaks, and then create a first downward break. In this case, you will draw your first buy trend and check that the price has indeed dropped if it returns once to this buy to sell and gives you a second break. If that is the case, then you are simply EPA to the downside. There's nothing more complicated, guys. You'll see that it's really super simple to find your bias thanks to this concept. Now you will be dealing with IPA, which stands for inefficiency price action, from the moment the price does not return to revisit your sell to buy and buy to sell zones. Let me give you an example. You are bullish, right? You have a breakout and the price does not return to visit your sell to buy zone in order to go higher. Well, that's simply because you are inefficient. If you are inefficient, you simply won't trade. So when you see these structures, you should avoid the chart. We can also look at the example in the other direction. You see that the price makes a breakout, okay? It makes a second breakout. Each time the price breaks out, you will draw your buy zone, okay? To sell. You will check that the price indeed returns inside, but if the price does not return inside and gives you a second breakout, then from that moment on, the price is no longer valid. So, you move away from your charts. So, the 4 diagrams to remember here are the bullish one, the bearish one, and the one where we come from a bullish structure and transition to bearish. There you have all the diagrams. Let's move directly to a concrete graphical example. In the application part, we start directly. So here you can see that the price makes a first breakout, so I will begin to draw my sell to buy. We will check that the price comes back down to give us a second breakout, and if that is the case, well, from that moment on, we will define that we are bullish. So, be patient. The price sorts us out with a second breakout once you are in this setup, and well, you will be able to trade your sell to buy, meaning you will be able to place it in the analysis zone to buy the price. These zones serve as observations to take a position, so we carefully watch what is happening. The price continues to rise. If the price returns to this zone and gives us the entry, we will simply be happy to buy the price. So you see that the price indeed comes back inside, so we would have an excellent buying zone, since we first defined that the price was efficient upwards, which means that the trend will certainly be bullish. From that moment on, we will be able to continue to be supported in the upward direction. The price continues to rise and we will be able to exceed our zones again and again. So we have a new sell to buy. Do we need to wait for the price to come back inside to reassess? No, he has already done it once. Every time he returns to the zones, they are simply buying zones that you can take into account. So we look, the price returns inside. Simply you have a new interesting buying zone. The buying zone has been determined. You can continue to trade in this buying zone. We move into my next sell to buy. And similarly, each time the price returns within, you will have buying zones that will occur. Throughout the video, you will be able to understand when to take them and when not to, thanks to different aspects such as timeframes, for example. We continue to observe what the price is doing. Our price simply returns inside. It could give us a buying zone in that spot. It gives us a buying zone again, and the price just keeps rising. And you will be able to repeat this pattern over and over again. The key is to understand that you need two short cases as a foundation, okay? One of which is the sell to buy, revisited at least once to provide the second question. Once that is done, you just need to move your analysis zones. I mean your sell to buy zones over and over again. So we are going to do several examples together. You see that, boom, you have had another increase, and here we are on time frames like the 4-hour chart. So you can see that it still gives you great movements for your intraday trading, and it's not that complicated to trace. Okay, we will be patient. So here you see that a first break is made, so if a first break occurs, you will draw your buy zone on your own, and you will look to see if the price wants to return inside to create a second break for you. If that is the case, we will move to sell. So here you see that it also makes a liquidity grab. So at this point, we don't know which way it's going, okay? We're neither bullish nor bearish at this moment, so we're just going to draw our zone here and see if the price wants to give us a second break. Here the price returns inside and it takes liquidity from you at that moment. So you have a break of a break, it comes back inside and gives you a sell signal, okay? So that's good. Right here, and you will start your pattern again from the moment you have changed your bias. That is to say, you see that we have shifted from a bullish bias to a bearish bias. And to regain a bullish bias, we need to wait for our initial schematic again, which means our two breaks here. I start with a sell to buy. We will first check that the price indeed returns inside this sell to buy. If it gives us a second break inside, then we can simply start trading buys again. So for now, we are not trading buys. We wait, we wait, we wait. You can see that for now it is visiting our zone well, meaning that if it gives us a second break, we will simply be happy to buy back. So here the price gives us a second break, which means we will be very happy to buy back here. Okay, we have our sell to buy. If the price comes back inside, then we can simply make a buy. We wait, we wait, we wait, and there you go, you can make a buy. There you go, very simple. Nothing complicated. And I will now be able to give you an exercise along with the solution. Once this solution is validated, you can move on to step 3 of the video. Alright, let's move on to the exercise. Okay guys, for this exercise part, I am giving you the exercise to complete between Monday, November 20th and December 13th. You need to complete the exercise and I will provide the correction right after. Okay guys, so here is the result. You can see that we have a breakout here, 2 breakouts, but the price did not come back to give us a buy. It created structure above. It created a break for us, 2 breaks. The price returned to that break, giving us a sell. Although at the first break, we returned to the sell to buy zone to give us a second break, which means we transitioned well from bearish. We come back inside, we can play the sell. Here, you see that we are inefficient, so when we are inefficient, we will wait for our schematic to become efficient again. We can see that there is a breakout, and we can see that there is a second breakout. At the end of this first breakout, the price has returned well into our buy, giving us a new selling zone. And this selling zone has allowed us to take profit. That concludes part 2. We will move directly to part 3. Here we are in part 3, and we are talking about liquidity. Now that you understand how to outline the market structure and the principles of efficiency, we will be able to understand liquidity. So liquidity is really not complicated. You always need to understand efficiency. As you can see, we have our first breakout right here, our second breakout right here, and we have indeed revisited our sell to buy zone. It's clear that in this zone, we had a second breakout. Once you grasp this concept that you are efficient and that a lot is picked up, you have a liquidity grab, and this liquidity grab will give you a new breakout here. This means that from this moment on, you will be able to look for buys in this zone. That's what a liquidity grab is. This liquidity, we will call it the weekly one, whatever you want, but it is a liquidity grab for us. So you just need to remember that in these cases, we have a liquidity grab. Now we can continue. You see that we have a break, 2 breaks. Here we have a liquidity grab, all right? And simply put, we will look to take sales at this point. Nothing more complicated. If you have understood the market structure, know how to draw it, and grasp the principles of efficiency, this part should seem really simple to you, okay? The hardest part might be the principles of efficiency. Now, you know how to draw them, and you just know that when you recover a lot and you are given new structure here, we are definitely going to buy, but it's simply what needed to be understood. So I will show you examples directly in practice because the theory was really not very long to explain. Practical part for this part 3 of the video, we are simply off. So we see that we have a first break, a second break, and we will always check on our first break, our buy, all of that. Are we really back inside? Yes, we have indeed returned inside and we have been given a second breakout. So from that moment on, we will be able to observe our zones. In this part, we will particularly observe our highs and check if we are experiencing liquidity grabs or not. If we are experiencing liquidity grabs, we will simply want to trade downwards. So here you can see that we are well within the zone and we have continued to decline, which means our efficiency principle has been respected. However, what interests us most in this part is really looking at our liquidity grabs. Once you understand this, you have honestly grasped the hardest part, and we can move on to the last part of this video, where we will talk about timeframes. So make sure to stay until the end, because if you understand all this without understanding the timeframes, it would be a bit foolish. You can understand everything, but by forgetting the principle of timeframes, you will really forget 90% of your win rate. So here we recover a high, and we will see that our preferred target will simply be the low. This is a liquidity grab, so we can name it liquidity as we saw just above right here. I note it down here, liquidity, and we are good for that. Let's continue. So there's no need to explain the principles of efficiency to you over and over again. The price is doing its own thing. So what does it do here? It takes liquidity from you, all right? Therefore, every time you are in a downtrend efficiency principle and the price takes liquidity from you, you will simply look to target your lots. It will always be the same principle over and over again. So here the price has made a liquidity grab. The price continues. Okay, it breaks again. Here it makes a liquidity grab, so you note it down. And every time you have a liquidity grab, you will aim to target your lots. You know the rest because we saw earlier what he was doing. The price is going to seek our lot, so this liquidity grab is still viable. The price continues. The price definitely continues. The price absolutely continues. Here it makes a new liquidity take, and from this liquidity take, we will want to seek our lots. That's why you might ask me, how do we differentiate an efficient principle from a liquidity take? Well, simply put, you will always be in observation. This means that with your efficient principle, you will be observing in order to trade the decline directly. If a setup is given in that area, it means you have an entry setup, and simply put, that area is good, so it won't necessarily break. On the other hand, if this area is visited at, for example, 1 a.m. or 6 a.m., it is very likely that 9 a.m. will come to recover the highs and give you a liquidity take. Moreover, you will see that all the liquidity takes are given to us at timings that are extremely relevant. So for example, here we are in the New York session, here we are in the New York session, and here we are in the New York session. So the 4 liquidity takes we just saw were made during the New York sessions. Is it a coincidence? No. And by the way, this introduces us to part 4 of this video, where we will be able to talk about timings. First of all, I will give you a little exercise once again, so you can apply it in practice. For this exercise number 3 in practice, I give you the zone from March 6 to April 5 and I reveal it to you right now. For this exercise, there were only 2 liquidity takes to identify, so here they are. The first liquidity take occurred on March 18th. So here you are on a completely efficient principle. We recover your lots, we are going to target your highs. The second liquidity take, you see that the price continued to rise, and then you perform a liquidity take here on April 5th, 2024. If you have found these results, well, congratulations. You are ready to move on to the last part, which is the timings. Here we are ready for the last rule, which is the timings, and these timings are simply very important to respect. The timings we will respect are the opening of London, the opening of New York, and the closing of London. These are the 3 timings you will be able to observe throughout the day. Once you have adhered to these 3 timings, you will simply be able to filter out the majority of losing trades and find the winning trades thanks to these timing sections. So we will definitely look at this between 9 and 9:45, around 10 U. You will look at this between 2 U and 3 U, and that between 4 U and 5 U approximately. Once these timings are respected, as I told you, you will be able to avoid the maximum number of losing trades. I will show you some practical examples, but for the theory, aside from explaining that we need to respect 9 a.m., 2 p.m., and 4 p.m., there is nothing else to explain, so we will move directly to our practical part. To put this part into practice, there is nothing complicated to do. What we will do is revisit the examples we have seen together throughout this video and look at when we had our liquidity takes, when we return to the principle of efficiency, and you will see that each time we come back to the timings. So there is really not necessarily any randomness to what is happening, and that is what needs to be understood. So you see that here we came to take liquidity at the costs of 8 o'clock, 9 o'clock. So there are certainly setups that were established here. Here we recovered liquidity at the 4 p.m. mark. So you see there is still a timing we observe here where liquidity was recovered at the 11 a.m. mark. So we weren't in front of the charts, but our setup was well established at 4 p.m. Okay, you see that starting from 4 p.m. the price began to rise. Sometimes your liquidity takes may not be recovered within your timings, but your setups will still be provided later within your timings. You still need to stay in front of the charts, analyze, and watch what will happen during your timings. But if they are not recovered within the timings, well, that's okay. You can look a little higher to see what is happening. Here, it's the same. It was recovered, you see, at the 4 p.m. mark. So each time we will recover during these sessions between 4 p.m., 9 a.m., and 2 p.m. We will be able to look at all our efficiency principles that we saw at the beginning of the video in H4, and each time we were going to mark small red dots, we will check from what time it was interesting to buy. So here we see that it's exactly 2 p.m. coming up, so 2 p.m. is coming right at this spot. Well, is there a logic to be able to buy here? Absolutely. While here, we come at midnight, so you are completely asleep. For example, here we come back from 4 p.m. to 5 p.m, a great point. The price continues to move. We return to this zone at 1 a.m. You are not in front of your charts, you are not trading. Here we return to this zone at 5 a.m, you are not trading either. And we finally return to that area starting at 9 a.m. So it's a great area to trade. I think you understand, timing is something super important, and it is actually the holy grail. Why? Because it will prevent you from looking for trades in that area. So we can remove that circle, which will save you from looking for trades in that area. This way, it helps you avoid taking a small dip. And we will keep only the most important points in the market thanks to timing. So, using the timing filter, we would take this point, we would take that point, and we would take this point. It's a wonderful filter that really allows you to increase your win rate and eliminate, as I mentioned, the bad trades. If you enjoyed this video, feel free to give it a thumbs up, comment, and share the video with those who want to discover algorithmic trading. I'll leave you with that, so see you next time.